Hi everyone, and welcome to the first year experience of financial literacy, presented to you by Student Financial Services. Student Financial Services is your go-to for anything related to finances, including billing, health insurance, financial aid, and scholarships. Today we are here to talk about your financial literacy. Financial literacy is the ability to understand and effectively use various financial skills, including personal financial management, budgeting, and investing. Financial literacy is the foundation of your relationship with money, and it is a lifelong journey of learning. And throughout this presentation, we are going to be sharing some interesting statistics in the form of questions and answers. Our first question is, what percentage of adults are financially anxious? A, 20%, B, 37%, C, 53%, or D, 61%. Please take a moment to answer the question and don't be afraid to be wrong. These questions are only here to provide awareness.
The answer is C. Unfortunately, many Americans aren't financially literate and experience stress over it. Studies have found that financial capability, stability, and confidence aren't improving. Over 53% of adults say thinking about their financial situation makes them anxious. 44% say discussing their finances is stressful, and younger Americans are feeling the greatest burden. The study found persisting and widening gaps between those who are struggling and those who are prospering financially are changing from generation to generation. People between the ages of 18 to 34 have the highest levels of financial stress and anxiety. So, why is financial literacy important? Because it gives you the knowledge and skills you need to successfully manage your money and can provide guidance for short and long-term financial goals. Statistically, 62% of adults carried credit card debt in the last 6 months. At least 1 in 4 admit they do not pay their bills on time, and nearly 6 in 10 adults find it difficult to minimize their debt because of unexpected financial emergencies or reductions of income. This is a situation everyone would like to avoid and can be worked on with the help of financial literacy education. So let's begin. Today we're going to review how to create a personal budget, the importance of saving money and maintaining a budget, how to pay for your education, and financial aid awards.
Before we start, let's take a look at another statistic. What percentage of adults do you think live paycheck by paycheck? A, 42%, B, 55%, C, 67%, or D, 78%. Please take a moment to answer. The answer is 78%. A majority of the country is currently living paycheck to paycheck, which means you are spending most or all of your monthly income on expenses. Once essentials are paid, there's no money left over for savings. If savings run out, what is your plan B? Unfortunately, for many Americans, there isn't one. Given the current economic downturn due to the pandemic, the number of Americans struggling to make ends meet is likely exacerbated, and jobless claims total around 33.5 million. Now let's talk about budgeting. A budget is a financial plan for a defined period, normally month to month, that is known to greatly enhance the success of any financial undertaking. Having a budget can reduce the amount of anxiety when it comes to saving and spending, and it helps you visualize where your money is being spent on a weekly or monthly basis.
Here's another question to make you wonder. How many adults do not keep a financial budget? A, 1 out of 5 adults, B, 2 out of 5 adults, C, 3 out of 5 adults, or D, 4 out of 5 adults. Take a few seconds to answer. If you guessed C, 3 out of 5 adults, then you are correct. In 2019, a survey revealed 3 in 5 U.S. adults said they have a budget and follow it to keep track of spending. But the survey also revealed 3 in 5 U.S. adults self-reported that they do not have a budget. Maintaining a budget is a financial literacy fundamental. A budget sets the foundation for how to handle your income and expenses. It ensures that needs are covered each month, the essentials like bills, debt, and savings. It's eye-opening to learn a majority of Americans don't budget. Without a budget, how do consumers maintain confidence in their financial stability? How do they hold themselves accountable when managing money? Well, a main way to budget your finances is to track your spending so you can track your savings. It is beneficial to calculate your monthly budget by tracking your monthly income minus your monthly fixed and variable expenses. To begin, start by tracking your monthly expenses and then identify the fixed and variable expenses. Next, add up the total and study your variable expenses to see what can be modified. Lastly, set your budget so you can then factor in savings. Always remember, it is recommended to find ways to increase your income and decrease spending to achieve short or long-term goals.
If you need help to do this, there are many budgeting resources available. There are a couple of apps you can download on your phone, such as Mint and EveryDollar. If you're comfortable, these apps will be linked to your bank account so it can track your monthly income and expenses for you. It couldn't be easier. Another way is to use an Excel spreadsheet, or if you'd like to be more hands-on, you can grab a pen and paper to manually track your monthly budget. Another statistic to be aware of is what percentage of adults had credit card debt in the past year. A, 45%, B, 60%, C, 72%, or D, 81%. The answer is 60% of adults had credit card debt in the past year, and nearly 2 in 5 indicate that they carry balances from month to month, resulting in interest and late fees. According to the Federal Reserve Bank, Americans owe a record high in credit card debt, topping $1 trillion. Creditors report an account is delinquent once it reaches 30 days past due, so 90 days past due is marked as a serious delinquency. Credit card debt is considered to be dangerous because the high interest rates and low minimum payments can lead to a vicious cycle of debt. If any of you have had a month where you couldn't pay off your credit card debt, then you may know what I'm talking about.
Here is a sample of what a self-made budget may look like. At the top, we have our monthly income of 2 biweekly paychecks. Below are monthly expenses, such as fixed and variable, that we have mentioned before. Each section is totaled to show that this individual has a monthly savings of $180. Unfortunately, that's pretty low. In order to cut back on expenses and save money, first examine your variable costs. Variable costs are expenses that fluctuate from month to month, such as utilities, groceries, entertainment, and anything else that is subject to change. A good way to save on your utilities is to not leave your AC or heat on when no one is home. Another is trying to conserve water usage by limiting how long you leave faucets running. You should also make sure to turn off your lights and any unnecessary appliances while out or when you go to sleep in order to lower your utility costs. One of the best ways to be mindful while you're at the grocery store is to make sure you don't shop on an empty stomach. That being said, try examining what you buy and see what non-essential food or drink expenses you can eliminate. Can you cut back on snacks, soda, or candy? What about getting into meal prep instead of ordering takeout? A great way to save on money is to make your own coffee and tea at home or work instead of shopping at Dunks or Starbucks on the way. Now let's say we take those suggestions into consideration. By being more mindful of where our money is going and making some cutbacks, we can see an increase in our monthly savings. As previously mentioned, variable expenses are the ones that can fluctuate each month. If we cut back the highlighted expenses, we can see a possible savings increase of $180. That's double the amount of savings from the original sample. How much of a difference can those small cutbacks make? If you think about it, it can make a bigger difference than expected in the long run. By cutting back only $50 a month, you can save up to $600 a year, or you can save $1,200 a year if you save $100 a month. Sometimes when we make small purchases, we excuse it by telling ourselves, it's only $5. But over time, that $5 purchase can total up to $50 a month. Imagine cutting back on something small like $10 a week at Starbucks. By the end of the month, you can save $40, and after a whole year, you can save $480. And that's only from cutting back on your coffee. Think about how much more you can save when you really examine your expenses and what you can do with your extra savings.
Another important tool is to ensure that you have an emergency fund account. How many families do you think do not keep an emergency fund account? A, 1 in 3 families. B, 2 in 3 families. C, 1 in 5 families. Or D, 2 in 5 families. The answer is B. According to an analysis from J.P. Morgan Chase, a majority of families in the U.S. don't have enough money saved in an emergency fund. The research recommends families aim to save at least 6 weeks of take-home pay. This is a departure from the traditional recommendation of saving 3 to 6 months worth of take-home pay. The reasoning is that a small buffer can help families weather a financial upset, such as a reduction of wages or a spike in expenses. Even so, about 2/3 of American families would struggle to come up with the equivalent of 6 weeks' savings. A tremendous percentage of the population is at risk. With financial ruin, one unexpected expense away, this statistic emphasizes how critical building an emergency fund is for long-term financial health.
Now we're going to transition into financial aid. When it comes down to paying for your education, there are a myriad of things to consider, such as thinking about how you will pay for your program in its entirety and not just semester by semester. How much of your bill will be covered by aid? Being mindful of how much your aid you will need to repay. Being aware that there are annual and lifetime loan limits as an undergraduate. Question what other funding is available.
There are many different types of aid you can look into to see what you may or may not be eligible for. There are 2 federal grant programs available to students who demonstrate need, which are called the Pell Grant and the SEOG grant. State grants that may be available require you to be a legal Massachusetts resident for at least 1 year prior to the academic year you're starting. It also requires a submitted FAFSA application for you to currently not have any defaulted student loans. You can also apply for institutional scholarships. Institutional scholarships are given to students by Cambridge College. To apply, visit our site here. If you have submitted the FAFSA, which I strongly encourage you to do, you may be eligible for a federal loan which has low interest rates, much lower than a private loan. Something important to note is that there is a maximum amount you are eligible for each type of aid. There are limits for what you can borrow per semester, academic year, and lifetime. As an example of eligibility limits, the Stafford loans have limits that you can borrow each year depending on how many credits you have finished. When you submit the FAFSA, you will always be considered for Stafford loans if you have not reached your lifetime borrowing limit, which is $57,500. For an independent student, based on your credit completion, the number of credits completed determine your grade level for loans. For example, for any student who has finished up to 29 credits will be considered a freshman and eligible for up to $9,500 in loans. Similarly, if you've completed between 30 and 59 credits as a sophomore, you can borrow up to $10,500 for the year and $3,500 each semester. It is important to remember that Cambridge College is a trimester school, and your aid will be divided into thirds across your academic year. One thing you need to keep in mind, if you are a part-time student, you should take into consideration how much of your aid will cover your bill. You may be in school for 4 to 6 years, and therefore you want to be sure you are also thinking how you can fund your education in future semesters and the years down the road.
The Pell Grant is only awarded to undergraduate students and is dependent on your expected family contribution, or EFC for short. The eligibility amount is also dependent on your enrollment status. For example, if you are enrolled full-time, you will be eligible for more Pell Grant than if you are enrolled half-time. The Supplemental Educational Opportunity Grant, or SEOG, is an additional grant for students who demonstrate financial need. In order to receive it, you need to be eligible for the Pell Grant and have submitted your FAFSA on time. Students are eligible to receive up to $500 for the academic year, which breaks down into approximately $166 per term. The table in front of you shows an example of what an award for first-year undergraduate students would typically look like. The student is enrolled in 6 credits for the fall, 9 for the spring, and 12 credits for the summer. As mentioned earlier, anyone with up to 29 credits can receive up to $9,500 for the year. This is divided into 3 semesters, which comes down to $3,166. For the fall and spring semesters, with the student's enrollment accompanied by loans and grants, the student will receive a refund. For the summer semester, the student will have the balance left over because they did not have enough in loans and grants to cover their tuition costs. To help finance the outstanding balance, you can enroll in a payment plan. You can choose from 3 different payment plan options, 3, 4, or 5 months. The payment plans allow you to pay your tuition and fees in smaller payments over time.
Cambridge College has partnered with IBA Boston, a new financial literacy resource for students. Developed in partnership with the City of Boston and the Boston Builds Credit Program, this initiative promotes comprehensive financial well-being for all participants. Students will learn how to improve their financial skills and gain control of their finances through workshops and seminars. For Boston residents, there is also one-on-one coaching available. IBA Boston is a free service for Cambridge College students and can be contacted at 617-819-5498 or www.ibaboston.org. Also, feel free to look them up on YouTube for more information. Of course, our office is always available for any and all financial aid questions and concerns you may have. Below is a list of our office's counselors based on their caseload by student's last name. Please feel free to call or email us anytime. Our office is open 9 a.m. to 5 p.m. Monday through Friday. As we come to a close, here are some resources that can help you gain control of your finances. We hope you found this information helpful. If you have any additional comments or questions, we are always here to help. Thank you.